Am I going to have another busy week like last week? Can I just look forward to Turkey, or is it going to be bumpy?
I think, yeah. We're still very much in a choppy trading environment,
okay.
I think is the headline. We talk a lot about the center rally into year end, then people get optimistic, but I think what's less appreciated is that there's also a seasonal component to volatility. So you see that it generally tends to decline into the Christmas period and into the summer. Now, in theory, that's a positive. I think the issue is, yes, you decline into Thanksgiving, but you don't really get more subdued volatility until the middle of December. So that's still a couple weeks away. And you don't really have any use for seasonals unless there's a reason for them. And the reason that seasonals decline at that point in terms of volatility is because you have fewer central bank meetings, you don't get data coming out, and we have the opposite right now. We're getting an excess of data coming out. You also have the December Fed meeting where there's a lot of focus for that meeting because we're unsure of whether or not they'll cut, or at least the market doesn't have a strong view either way. That pricing needs to shift into the meeting, or at least, you know, if it comes down to the wire, you'll have the shift on meeting day. And that means that you're still in this kind of choppy environment because your two seasonals that are supportive in terms of data and Fed aren't there.
How much of the rally that we've seen so far, and even arguably the rally we're seeing this morning, is dependent on the Fed continuing to grease the equity market's wheels? In other words, how dovish does the Fed need to be to sustain the green on the screen?
Yeah, I mean, I think it depends on what kind of time frame you're looking at, right? So if you have a Fed that doesn't cut in December, that's certainly not positive for equities into year end. I think, though, in the longer term, if the Fed keeps cutting towards 3% and the easing cycle that we're in currently, then that can be quite positive. We're not talking about this yet, but if you have a complete 180 on the Fed, as in we're not looking for any more cuts, we're starting to think about hikes into 2026, which I think is a real possibility when you think about the fact that we've had monetary easing. We're close to what could be a neutral rate in the U.S. You have fiscal easing that could get more aggressive into next year with talking about kind of helicopter money around $2,000 just being given out to U.S. Americans. If that happens, then I would start to get more concerned, or if it's inflation-led, because for the equity market, it cares very much what's driving inflation. If it's growth inflation positive, then that's positive for equities. But if we just have inflation without the growth, then I'll start to get more worried too.
In terms of what else we're going to watch this week, how big a factor is the budget going to be? Is that the main event this week out of the UK?
Yeah, I mean, definitely for the UK, it's the main event. I think, though, I'm less pessimistic than generally people in the UK tend to be, or even the market is. There's a lot of
very optimistic people.
There's a lot of pessimism priced in, I think, is number one. And I think what we underappreciate is that the government, while it may not be the smartest thing ever, they kind of test the market before releasing the budget. And we had that test a couple weeks ago.
So there's no
danger
that gilt volatility translates into wider bond market volatility?
Oh, no, there definitely is that risk. But I think it's maybe less worrisome now that you've had the market tested once on the budget already.
Okay. We are optimistic people, honestly. We just don't sound like it.
Yes, we all saw that. We see that every day.